Welcome to this edition of Fridays with Fintelekt. My guest today is Nithi Genesan, Director of Compliance in the Singapore operation of Waystone Compliance Solutions. A few words about Nithi before we start. She is a compliance and regulatory specialist with over 15 years of experience working within the financial sector and an in-depth knowledge of the laws and regulations of the financial markets. Her vast experience includes working with securities, asset management, insurance, financial advisory, and payment services. Nithi holds a master's degree in applied finance from the Manchester Business School and is a graduate from the National University of Singapore. In addition, she is a holder of the International Compliance Association Diploma, a frequent speaker and panel member for various industry conferences and seminars. Nithi is also a guest lecturer at the Singapore Management University. Nithi, thank you so much for joining us today.
Thank you. Thank you for having me, Shirish. It's a pleasure.
So, Nithi, you have, as I said, extensive experience in regulatory compliance, AML, CFT, and governance. To start with, can you speak about your personal journey so far in the world of compliance, any key learnings along the way, and also a bit about your current role at Waystone?
Sure. So I think I started my career in compliance, I would say, in ABN AMRO Bank, which is, more of a banking compliance where primarily I was involved in the corporate banking side in terms of customer onboarding, periodic reviews. I think that was a good introduction to me, especially into the space of AML, KYC. I learned a lot there. And then I moved on to do compliance in a CFD leverage FX broking entity. City Index is the name of the company. Very different to a banking institution. Obviously, it's more broking where there will be retail customers as well. So again, I got a different perspective of compliance in that organization. I was doing a lot more transaction monitoring, looking at client profile, transaction patterns, trying to understand if any suspicious transactions are observed and how to deal with that. And also the dealers and the brokers, they fall under the Securities Futures Act. So that was, again, a good introduction for me to gain a in-depth understanding of a different act versus for the banks, which falls under the Banking Act. And then after that, I moved on to do regulatory compliance consulting with a firm called Compliance Asia. And I was there for a couple of years. And I would say that is where I have learned the most in terms of dealing with the regulators and looking at providing regulatory advice to financial institutions, varying from asset managers to financial advisors to brokers, insurance providers, across the board, basically. And again, the exposure and the experience I got in compliance is very different. I was primarily working with the asset management clients because they had the ability to outsource compliance to service providers like ourselves. But like I said earlier, we also got a lot of exposure in dealing with other financial institutions other than asset managers. So in terms of exposure for compliance, it was very wide, learning about different sectors, industries, within the financial sector, even learning about the different types of financial institutions there, the business model, and how compliance, especially AML, KYC, differs slightly from one sector to another. That was also interesting for me. And now I'm at Waystone, which is a compliance regulatory advisory firm here in Singapore. My role here is quite similar to what I've done before. I manage and look after the Singapore regulatory team, and we also do corporate compliance as an additional service for our financial institution clients. So again, I get exposed to AML KYC on two fronts. One is the regulatory side, which is advising our regulator financial institutions on MAS's expectation in terms of AML KYC when they onboard their investors. And then on the other side, I do get involved on the corporate compliance side, where financial institutions or non-financial institutions, when they are registered with ACRA in Singapore, what sort of AML compliance requirements that would be applied to them that they would then need to ensure that they are meeting before we accept them as a client. So I think overall, I would say I've had a good experience, exposure, especially in AML KYC in the last 15 years or so. Yeah, lots of takeaways, definitely. I'll be happy to share as we go along this session.
Fantastic. So, to get into the sort of meat of the matter, let's start with talking about AML CFT governance frameworks. I mean, what are your views on that? What is your view on, the tone at the top in terms of compliance culture prevalent in the APAC banking and financial services industry? I mean, do you think most of them are doing enough, or is it, still really just a tick mark item for most banks and financial institutions?
I think it has definitely changed a lot over the years. That's what I have seen. I think in terms of changes, I would say the first one would be the tone from the top. In my view, it's a lot more emphasized at the tone at the top in terms of senior managers, directors having a lot more keen interest in compliance and AML. I find that a lot of our clients are definitely putting compliance AML at the forefront, or at least alongside their business interest to grow their business. I rarely come across clients where they have, zero interest in compliance and meeting regulatory requirements. I think at this day and age, especially how the regulators have evolved, how clients and financial markets have evolved, it is very difficult to do a tick box exercise, which may have existed in the past. So definitely tone, culture, and emphasis in terms of compliance. I see that being put at the top and putting a lot of emphasis and focus on it. I think secondly, clients and financial institutions, they are aware that there are different regulatory obligations that are imposed on them at an individual level. So even if we take, for example, in Singapore, there is something called an individual accountability and conduct requirement, which is a guideline issued by the MAS, the Monetary Authority of Singapore, where they have identified and rather they have made it sort of compulsory for companies, especially if they have more than 50 employees in the organization, to assess what are the key people in the organization responsible for the different departments, for the key function, identify them, make sure that they are then held responsible for the function that they are carrying out, which includes compliance, AML, as key functions. So it is mandatory to a certain extent that senior managers are held responsible for how the company puts in place a compliance framework and meets the compliance obligation. It's no longer just, no one is held responsible. Somebody would have to take on that responsibility and would have to face the consequences if the company does not meet the regulatory requirements. So you would see that over the years, MAS and other similar regulatory bodies, they are issuing penalties on the individuals as well. So, which includes financial penalties, prohibition orders, giving out warning letters to the CEOs, directors, different individuals in the organization responsible for the various functions. Yeah.
Right. So, continuing, on, continue to talk about the Monetary Authority of Singapore. I think a couple of years ago, they provided some guidance on enhancing the robustness of enterprise-wide risk assessment on money laundering, terrorist financing. Now, do you see any challenges that banks or other reporting entities have faced or continue to face when they carry out their risk assessments? For example, would risk rating of customers, would that be a challenge practically? And, how would they overcome this and any other problem areas?
Sure. So in Singapore, for the enterprise-wide risk assessment framework, there are primarily 3 to 4 areas that a client needs to look at. One is where their clients come from. So if their clients are coming from FATF, Financial Action Task Force, high-risk countries, then that category does get impacted and becomes higher risk. And then they also have to look at the risk of their clients overall, not just the jurisdiction where they come from, but overall, are the clients high risk, low risk, or medium risk? Meaning, do they have a lot more politically exposed persons, connected paths within the organization? Do they have clients with a lot of adverse news media, which would then make them higher risk? That is another category that they have to consider. The third one is where the clients have operations and offices in as well, meaning do they have branches, parent entities, or subsidiaries in higher risk jurisdiction? Then again, that category becomes higher risk. And then lastly, they have to look at the products, the delivery channel, and the services that they're carrying out. Is their business model inherently higher risk? For example, pawnbrokers, to a certain extent, even corporate service providers. So these are the various factors that a financial institution would have to consider in order to eventually deduce what is their overall enterprise-wide risk assessment. But I think the key here is MAS is not prescriptive in the sense it's not telling you precisely this is the format to do, these are the questions you should be asking yourself. They've just given the guidelines, the framework, the guiding principles. But if, at the end of the day, each financial institution has to come up with its own methodology. Is it going to be, 4 factors with even sub questions below each factor? Is it going to be a point system? How do you eventually come up with the conclusion that you're high risk, medium risk, or low risk? That methodology is important. The second part is what do you do with the results? Say you've done the assessment and you're deemed to be higher risk or medium to high. You have to present what are the mitigating controls that you're going to implement within the organization to reduce the risk exposure of your organization, because that is the ultimate aim of any such EWRA assessment. You understand your risk, and then you put in place the controls and the measures to reduce the risk. So that is where organizations I find are lacking slightly, where they merely do the assessment to understand the risk, but they're not doing enough to sort of really understand how to bring about a reduction in the risk exposure in the various categories that they have identified themselves to be of higher risk. And also involvement of board of directors is important. In Singapore, you are required to, especially for the asset managers, you have to do the EWRA once every 2 years to take a stock check on where you are at on EWRA, and also present the findings to your board, as well as the mitigating control measures that you're implementing to address the risks. So this report has to be presented to the board and be escalated and communicated to them so that they are fully aware of the organization's EWRA risk, as well as the mitigating controls that the company has put in place.
Right. So, Nithi, over the last almost 3 years, I think the pandemic has been instrumental, to the rise of digital banking. Are there any specific AML risks that you see emerging or have emerged due to the shift to digital banking, especially as customers using this, mode are likely to have very little or even sometimes no face-to-face contact with the bank? And also compliance costs are increasing. So digital banks have to keep their operational costs low to ensure, better competitiveness. And, how do you see these contradictory issues being addressed, especially when regulations are still evolving?
Sure. I think digital banking moving towards online, non-face-to-face KYC customer onboarding is the trend that we're going towards, or rather we are already on that trend. We're going to see a lot more of that. That's my view. And the reason is because as financial markets evolve, so does the technology infrastructure. We are seeing advancements in the technology front. And so it's almost like the financial market has to catch up to meet the technology developments, which is why I see that, and I'm sure you also have noticed that, the different financial players are so varied right now. the type of financial clients we see, the type of asset managers, the type of business models we see, payment service providers, they are so varied in this market right now compared to even say 4 years ago, 5 years ago. So it's almost like it's unavoidable. I think financial market and the regulators would have to think how to address and keep in check AML risks at the same time, be forward thinking, be forward in terms of accepting of the new type of financial models that they're going to be seeing. So some of the challenges how clients are addressing when they are doing non-face-to-face customer onboarding, uh, I would say the main way I see clients addressing any increased risk is utilizing technology solution to help them with the authentication of customer data documents, as well as to avoid and to reduce impersonation risks. So there are solutions out there where it would be able to verify if, say, someone is holding their passport, is it truly a accurate, not a fake passport. There are solutions out there where they can do a quick facial analysis uh, of the person in front of the camera and the documents that they have uploaded to match, to say that yes, this is the real person that you're speaking to. It's not a fraud or impersonation risk happening. So without the technology interface, I think then the risk does go up, because if you're not meeting them face to face, you're just relying on what the customers are sending to you via email, not providing certified true copies, and there's no real authentication methodology that you're using to verify the identity of the customers. That's where the risk increases. But with technology, I think it can be managed.
Right. So, Nithi, earlier this year in February, I think MAS also issued a circular on, the same topic of non-face-to-face customer due diligence measures, and the intention of that was really to highlight some of the industry good practices, some of which you just spoke about, as well as, ongoing supervisory guidance, on the measures to mitigate risks associated with this. Now, what would you say are some of the key takeaways of this particular guidance, and do you see it actually being implemented in the industry?
Um, I do see it getting implemented in the industry. I think the key takeaways is definitely understanding what are the additional due diligence measures you're going to be using if you're doing non-face-to-face customer onboarding. It cannot be the same level of standards that you would use for a face-to-face customer onboarding. That's the key thing that financial institutions have to take note. Then comes the question, what are the additional measures? You have to be quite specific in your KYC policies and procedures, meaning, do you obtain certified true copies for all customers? When do you not request for certified true copies? And then how do you do the verification process? Because for KYC, there's always identification, which is first step, where you collect all the information and the details of the customer. Then you go to verification, which is collection of the independent documents to verify the information you have collected. So again, in terms of verification, how would you intend to do it? How do you want to do it? Again, do you ask for certified true copies, or are you going to allow a customer to come online and do a live onboarding? And if you're doing a live onboarding, how do you prevent impersonation risk? That is the key question that MAS is asking, and they want financial institutions to consider it. So if you're not using some sort of technology assistance, or you're not using one of those government issued portals where uh, like Singaporeans or the PRs, they are able to register their KYC details. If you're not using something like a database that is issued by the government, you're not using a technology to prevent fraud or impersonation risk, then MAS is a little bit more concerned about your KYC methodology and your procedures. So I think as the next steps, we would advise clients to have a look at the circular MAS has provided on non-face-to-face customer onboarding. do a gap analysis against their current policies and procedures versus against that circular, and see where they are lacking and what are the next steps that they should look into to address the gaps. That could mean, maybe adding a different process for non-face-to-face customer onboarding, looking at investing in a technology interface to help with the verification process, or a combination of one or two methods.
Right. So, speaking of the same, AML, KYC processes, I mean, which ones would you say are generally considered for outsourcing? And if so, what is the expectations on regulated entities when they outsource AML, KYC processes?
Um, I think different aspects of AML KYC can be outsourced. Certain things cannot be outsourced. For example, the process of identification verification, especially if you look at a asset management sector, the subscription documents, the subscription process, the collection of the verification identification document, that can be outsourced to a third-party service provider. They can also help with the AML screening of the customers, which is basically using a commercially available database to do the screening to see if there's any hit on the clients, whether they are sanctioned hit, PAP hit, or any other adverse media news hit. So though all of that can be to a certain extent outsourced, but when it comes to the eventual risk rating, deducing what the risk of the customer is, I'm not sure how much the service providers can do that, because at the end of the day, you know your customer the best. I don't think service providers want to take on that responsibility of saying your this particular client based on all these factors is high risk or low risk. So that discussion has to be had with the service providers. I think that usually is done in-house. The second thing would be continuous monitoring. MAS has already said that transaction monitoring is something you cannot outsource to your service providers. That must be done in-house. So again, for you to do transaction monitoring, you must know the profile of your client, the risk of your client, and then look at the transactions that they are undertaking in order to see if there are any anomalies or outliers in the transactions to raise your suspicion. So again, that is not something that service provider can help you with. The last one would be periodic due diligence. So a lot of service providers can help to do bulk screening of customers. They do sometimes on a daily basis. They do it, on a weekly, monthly, or as and when the lists get updated. That is again fine, but MAS has also said that for high risk customers, you have to get updated documents from your client. So who does that? Is it the service provider going back to the customer to ask them for updated documents and then doing the screening? Or are they relying on the client to go and reach out to the customer to ask for updated documents? Whether you need to ask for updated documents in order to do periodic due diligence on low risk clients, it's not as mandatory as it is for a high risk client, but we always tell our clients that you should still aim to get updated information and documents for all clients when you're doing your periodic due diligence. The answer is basically simple because especially if you're dealing with a corporate client, directors come and go, corporate level information can change. So someone you onboarded today, that company can look quite different even 3 years down the road, which is why when you're doing your periodic due diligence, you should attempt to get updated documents. And again, the question is, who does it? Can you actually rely on the service providers to do that? So I think there has to be an understanding between the client and the service providers, what they are helping you with, and then what are you doing in-house? And then do you have access to whatever they have done on your behalf immediately? So that you are able to make your own judgment and assessment. And the most important thing is clients have to remember they are regulated. So the responsibility goes back to them, no matter how much they outsource to a service provider.
Right. Uh, Great. So, Nithi, everybody's talking about virtual currencies these days, right? It's a very hot topic. And, there have been certain recent happenings, for example, like the FTX case. Now, what is your advice to banks and other reporting entities on how they should build in some additional red flag indicators, to safeguard the institution and also its customers?
Virtual currencies, I think it's a complicated topic, unfortunately. I mean, if I take Singapore as an example, virtual currencies is not recommended for retail customers. That is the stance. That is the stance that the regulator has taken. Of course, if you look at, say, for example, an asset manager, they can introduce a crypto fund and manage a crypto fund. As long as the investors are accredited institutional investors coming into the fund to partake in digital assets such as crypto, that usually is fine. Depending on how the business model is regulated, a lot of the crypto related players are unregulated at the moment. If the digital assets do not fall under the definition of a capital market product, which includes securities, that there's no underlying securitization of the token, then it is an unregulated product at the end of the day. So if you are selling an unregulated product and you are managing a fund that is investing in unregulated investments, then technically you are not required to be licensed by MAS. But I must make a disclaimer that it really depends on the business model, because there are certain nuances of a business model that may capture the client and put them squarely into the regulatory box. But by and large, if it is not touching securities, any other capital market products, then you can say that they are not required to be regulated. Then it becomes a question of if you're not regulated, then of course AML, KYC notices and guidelines is not applicable to you. The other aspect of it is if you are providing a digital payment service, that gets captured as a regulated activity as well. So a lot of the digital token exchanges, the digital token providers, anyone who's servicing clients in that space, they are required to hold a payment services license, which is a different type of license regulated here in Singapore. And again, there are very strict AML KYC applicable, very strict AML KYC requirements applicable to these clients. So I think the first steps is to understand, do you fall under the regulatory space or not? And if you fall under regulatory space, then you don't have a choice. You have to follow basically what the regulator expects you to do in the respective notices and guidelines. If you fall outside of the regulatory space, then it becomes a question of how do you protect your institution from fraud and terrorism risks, terrorism financing risks, because all companies are required to ensure that they're not aiding in terrorism financing and they're not aiding in money laundering, procedures or investments. So again, then you have to think about your customer onboarding process. How do you identify the source of funds, the source of wealth of your customers, which is the biggest risk for a virtual currency player?
Right. So, Nithi, most of our listeners, for this episode are going to be compliance officers, right? And they look to Fintelekt to figure out, what learning they should do. So, what is your advice to the compliance officer community in terms of the practical skills and capabilities they should develop to, become more successful in their careers, especially in these sort of uncertain times?
I would say, the best advice that I received is always number one, enjoy what you do. I think that's important, especially for compliance officers. Secondly, is always keep learning. That means never be afraid to look at different business models, look at different sectors. You don't have to restrict yourself to I'm only doing compliance for insurance or I only do compliance for a bank. It is always a good idea to keep your exposure wide, to really learn about different sectors out there and also widen your knowledge on different products. I think compliance officers who are able to help different type of financial institutions understand different products, investment products, insurance products. They are always going to be in demand, and they will always have an edge over somebody who is only looking at just one sector. So I think that would be my advice, which I was given. And generally, I think keep learning. That is the general advice, because regulations are constantly evolving. Even compliance officers such as ourselves, we have to keep updating our knowledge in the regulation, even in the country where we are working in. Uh, I also find it useful to look to other regulatory bodies, other countries, other regulators, and see what they have rolled out. Because sometimes looking at other jurisdiction, seeing what compliance or regulation is introduced there will give you sort of like a hint or a guide in terms of what's to come up in Singapore or in the jurisdiction that you are in. So that is also something that is something to look out for.
Well, on that note, Nithi, thank you so much for joining today. Thank you for these words of wisdom. I'm sure it's going to be useful for the community who's going to be watching this or listening to it. It was great speaking with you.
Thank you, Shirish. Thank you for having me, and look forward to speaking to you and everyone soon.
Likewise.